that's why we take pains to stress test our banks. So their starting point is already very high. So you have a situation where the capital ratios is at 18.8%. And the stress test that we subject our banks to, the details are in our EMR, are talking about, an economic environment is much worse than the pandemic. So you're talking about, a GDP contraction of much worse than what we saw in 2020. And you're talking about bond yields at levels much higher than what we have seen in the past, and even exchange rate against the US dollar at levels that we have not seen in the past. So when you took all that together, the bank's capital ratio is still above the minimum requirement. So no, our banks are still resilient, and we do not expect what we see in the other countries to happen here in Malaysia. And secondly, all our banks are subjected to very stringent capital and liquidity rules. Regardless of whether you are big, you are small, you are local, you are domestic, you are subjected to the same rules. Unlike in the US, where such rules are only applicable to the large banks. So when it comes to the mark-to-market losses, bonds that are whole in the banking book, which are not mark-to-market, is very small. It only accounts for about 6%, 7% of the total assets, unlike Silicon Valley Bank, which is about 40%. So, and even if you were to mark-to-market the 7%, the capital ratios of the banks would just decline by another 1 percentage point. And the capital rules currently requires bank to mark-to-market the bonds that they hold in the AFS, and such losses are deducted from capital. So that is our rule currently. So the 18.8% that you see are net of mark-to-market. It's already revalued at fair market values. And it is not true that some banks have written to us to get dispensation from complying with the accounting standards. And if they do, their accounts will be qualified in that case. And you will be able to detect that from the annual accounts.